Rohit Srivasstava is fund manager at Sharekhan. He's joining us right now. Rohit, good morning. Good to have you with us here. So we are exactly at 6,200. I don't see any reason why your view on the market would have changed from the last time we spoke. Still waiting for the fall, I guess, Rohit, right?
Sorry?
Still waiting for the fall, I guess, right?
Yeah, that's right. I still have the same opinion as far as the market is concerned. It's 50 points higher than where we were the last time, but we are really not seeing the kind of activity across stocks. The weak ones remain weak. There is strength in probably some individual names. If you just look at the advance to decline ratio, it's almost 50-50. So yes, we are on expiration date, and I think we're still waiting for the next leg down to start.
You with us here on opening fire. I lost Rohit there. I think we have the issue fixed. Rohit, can you hear me?
Yeah, I can.
Okay, thank God. So I was just saying that S&P's made a new high, a marginally new high. It got to about 1858 or so, right? Since the last time we spoke. That's one thing which has happened. If you look at US indices, does that change anything? And then I want your thoughts on China, which I'll come to in just a bit.
Right. See, the US market has a lot of divergences between individual indices. If I look at the Dow Jones, it did not make that new high. If you look at the Dow Jones Transports Index, it did not make that new high. If you look at the Russell, it did not make that new high. So essentially, you got a new high in the Nasdaq and the S&P, which is still not confirmed by many of the other indices. And most of the sentiment readings are at very extreme levels as far as the US market is concerned. So even though it may have bounced back after the January sell-off, my sense is it's just a matter of time that you'll see another leg down coming, and you don't have enough evidence to say that the bounce back is the continuation of a rally. There are a lot of negative divergences on momentum, especially at the weekly degree on the US indices, including the Nasdaq itself. So I think there's a lot of risk from the US market still.
Okay, there's a lot of risk. What about China? The Shanghai Composite is back at about 2,000 odd levels, right? It's come back to that level since 2008 right. Many times, but it's kind of been defended ever since. What's going on there?
Yeah, it's not just China. I think if you look at the BRICS, okay, as a whole, the BRIC nations, Brazil is very close to its 5-month low. It has been falling week after week for the last 4 months. Mexico broke its last week's low just yesterday, so it's again at a multi-month low. The Shanghai index was the only one which bounced back in the last 2-3 weeks, but in 2 days itself it has given up most of those gains, breaking most key levels that I would be looking for. So my sense is that China itself has started the next leg down. It's unlikely to stop at where it did in early Feb, so I think it's heading below that. And then you look at Russia, again very similar pattern, that it's been slowly declining. So I think India is the only market which is holding up at a much higher level than most of the others in the emerging markets pack. But that said, it is also making lower tops from the high that it made in early December. It fell, then it retraced around 78% of that in January. It fell again. Right now we are at around 61% of that sell-off again in February. So it's been a slower process than many of the other markets, but we are also slowly heading lower, and my sense is that we are far higher compared to the other markets and would probably catch up in the days ahead.
Globally, anything else that you are commodities, for example, what are you seeing there?
So in commodities, I think you got a good rally in copper and crude, but you need to watch these closely because they've reached key resistance levels, and when you start getting a sell-off in China, then I think there would be some risk to crude if it moves below, to copper if it moves below $3.24. which it did intraday, but if it closes below that, then my sense is copper would have started the next leg down. And one of the indicators to really watch from a US equity perspective is especially the precious metals. On a very long-term basis, the precious metals, and even in the medium term from a 1 to 2 month perspective, whenever you've seen the precious metals pack go up, then you've seen the US equities actually in a downtrend. So the precious metals pack, which is gold, silver, were in a downtrend for almost 2 years, and during that time period you've seen the US equities really outperform. Now what you're seeing is you got a double bottom in gold at around 1180, first time in July, and now second time in late December. And you're seeing a rally back from there. So I say my sense is, and also the second time it came to 1180 in December, there was very little selling volume compared to the first time when it was actually a panic. So my sense is that you have a bottom in place in gold and silver, which you're going to see much higher levels, and that itself is an indication that money is moving, slowly moving out of equities into precious metals as a risk-off trade.
Yeah. Here, just coming back to India, I know your view, we heard you saying, well, the eventual leg down will begin. Mostly people are converging to the view that the move will begin, but it will be a move higher. It could be before elections or after elections. Every week you get an opinion poll which sort of confirms the already existing view that a certain alliance will take charge after elections, and stock markets will rally quite aggressively and things like that. Any additional thoughts? I remember you saying, well, it doesn't really happen that way, and you went back in history and cited data. But any additional thoughts?
See, if you go back and see what happened in 1992 to 1995, the situation was very similar with the Congress government being in power, and a lot of measures that people were hoping for, like a second round of reforms, didn't really happen for a couple of years. Eventually, when the elections were fought in 96, you ended up with years of coalition governments, and things didn't move. But apart from that, you also need to see the economic cycles. Even back then, you had a period of high inflation and high growth, which actually started cooling off, and it takes quite some time for the economy to complete a consolidation phase and start up again. So we are having a very similar situation where the markets have been waiting for things to happen on the economy side, but if you just hear monetary policy, and the quote again and again is that itself is not sufficient to really drive growth, so you need much more to happen, and you can't just spend your way into growth, something that we did in 2009, and we ended up with 5 years of inflation. We've also not really fought inflation because we've kept real interest rates negative for most of this time. I think this is the first time that we are hearing the governors say that they want to actually target inflation. So, but still, they're doing it with 25 basis points at a time, which is really too slow if you really want to, attack that as a problem or consider that that's a monetary problem. So that itself is a debate in itself. So my point is that what are they going to do if a new government comes in place? Says you can take a lot of policy measures, but you're going to need, you're going to need money to move that, and that money needs to either come from outside or from within, and it has to not cause inflation. So you have to solve this problem first, before we can get onto the growth agenda. So whoever comes in will have to solve the money, inflation and debt problems before they can actually start working on growth, and that itself could take some time. Now all that said, the markets are anticipating some kind of rally pre-election, and I think probably the 1 or 2 month period prior to the elections itself, you could see that. But looking at the overall scenario which we just discussed, the world markets, the weakness in the emerging markets, the overstretched US market, I think the risk first is to the downside before you get a pre-election rally. So my view is that you'll probably see a sell-off in March, which could be driven by all those factors, and once you get a bottom sometime in late March or early April is where your pre-election rally would actually start.
Okay, first down and then up maybe. That's the view. Got it. Rohit?
That's right.
Okay. What do you have on in terms of trades right now, and what would you recommend?
So in terms of trades, we are seeing weakness in particular spots. The index has moved up because of some stocks like Larsen, but on the other hand, we are seeing started seeing weakness in the metal space. For example, Tisco. So I wouldn't mind being short on Tisco. We saw that in Hindalco last week. It's bouncing up a bit right now, so probably wait for a day or two, and then that would also be a sell. JSW Steel completed a pullback, which could be a sell from here. So I think metals is one space where you are starting to see weakness. We just discussed copper and China, which could be triggers. On the other hand, we are also seeing continued weakness in banks, and especially in the public sector banks, which are not really picking up. So I think when the next leg down starts being weak, that remains the weakest segment, and one could actually look at selling there as well. So these would be, I think, the two key weakest areas, but my sense is that most other sectors would also join in when you actually start seeing a sell-off in the index itself. So it should get pretty broad-based when that happens.
Rohit, thanks very much for your time. Good to have you with us here. Appreciate it. Rohit Srivasstava, Fund Manager at Sharekhan on markets, both local and global as well.